All right, let's talk about one of the most fascinating and frankly one of the most polarizing stories on the Indian market, Vedanta Limited. See, on one hand, you have this absolute powerhouse of world-class, low-cost mining assets. But on the other hand, you've got this high-leverage, incredibly complex promoter structure that just keeps investors on the edge of their seats. This is what we call the Vedanta Paradox, and we're going to break it all down.
To really get a handle on Vedanta, you have to stop thinking of it as just a mining company. It's not. It's more like a high-stakes financial instrument, and it moves to the beat of two very different drums. First, you've got the global commodity cycle. The price of zinc, aluminum, oil, you get the picture. That's its day-to-day reality. But the second, and you could argue more powerful force, is the constant liquidity need of its promoter. And that, right there, is the financial reality that truly defines the investment case for this company. So to figure out if there's real value here, we first have to really unpack this paradox, this fundamental tension between Vedanta's amazing operations and its unbelievably complex financial setup.
Okay, let's start with the basics, the actual business on the ground. Vedanta's footprint across India is just dominant. We're talking zinc in Rajasthan, aluminum in Odisha. Its core strategy is both simple and incredibly powerful. Produce things at a very low cost and at a massive scale. This positions them as a huge beneficiary of the whole India growth story. I mean, think about it. Every new road, every new building, every power line, they all need the stuff that Vedanta digs out of the ground.
Now, what's really cool is how this illustrates Vedanta's operational moat, its competitive advantage. Let's take Hindustan Zinc, for example. It's one of the lowest-cost zinc producers on the planet. That means it's making money even when commodity prices are in the gutter and its competitors are hurting. Then you've got the aluminum business, which is vertically integrated. They own their own mines, their own power plants. This whole structure gives them a constant cash cushion and protects their margins no matter what the market is doing. These are genuinely top-tier, world-class assets.
But here's where the plot thickens. The Indian operating company, VEDL, is controlled by its UK-based parent, Vedanta Resources Limited, or VRL. This whole setup, which came out of Chairman Anil Agarwal's super aggressive growth strategy, creates the central problem. All the real value is being generated down here in India, but a huge chunk of the debt sits way up there with the parent company in the UK. So the billion-dollar question is, how does the cash get from point A to point B?
And that leads us directly to the bull case, which is all about a major strategic pivot designed to solve this exact problem, the demerger. This is management's big play for what they're calling the Great Unlocking.
For the last few years, the main tool to get that cash from VEDL up to VRL has been dividends. And not just any dividends, we're talking massive payouts, over 70,000 crores in just the last 2 fiscal years alone. Now, retail investors, they absolutely loved seeing those 15 to 20% yields. But the more sophisticated analysts, they saw it for what it really was, a mechanism for the parent company to pay its bills, which in turn drained the operating company of capital that it could have been using for growth.
So this is the crucial moment. In 2023, they announced the plan to demerge the whole conglomerate into 6 separate publicly listed companies. The idea is to finally get rid of that conglomerate discount and let the market value each business, aluminum, oil and gas, power, etc., on its own strengths. Management is betting the farm on this, saying it's a transformational step that could unlock something like 80,000 crore rupees in value. It's a huge gambit.
So let's just quickly summarize the bull case. It really stands on 3 legs. First, you have value unlocking, the hope that the demerger will attract focused, institutional money. Second is the undeniable core asset strength. I mean, these businesses are globally competitive. And third, there's a kind of financial floor thanks to that high dividend yield and some recent debt restructuring at the parent level, which buys them a little bit of breathing room.
Okay, but for every bull case, there's gotta be a bear case. And for Vedanta, it's a big one. And it's dominated by that very same financial structure we've been talking about this whole time.
And this really illustrates the counterargument perfectly. That promoter debt overhang acts like a giant anchor on the stock. It leads to capital constraints because cash is always being funneled out instead of being reinvested. It raises serious governance and regulation concerns, which have historically stopped the stock from ever trading at what many think is its fair value. And of course, the underlying business is still at the mercy of wild swings in the market.
And look, this isn't this theory. There's a history here, a track record. Remember that aborted delisting attempt back in 2020? They tried to buy out minority shareholders at a pretty steep discount, and that really damaged their trust with big institutional investors.
More recently, there was that sudden high-profile pivot into semiconductors, which made a lot of people scratch their heads and ask about capital allocation. Actions like these are exactly why the stock continues to trade at a persistent governance discount, and why a premium valuation seems completely out of reach.
So, where does that leave us? We've got a pretty clear bull case all about unlocking value, and an equally clear bear case that's anchored by debt and governance issues. Let's try and pull these threads together for a final verdict.
This timeline really captures the strategic evolution, how management's story has changed over time. If you look at FY 2021, the tone was defensive, right after that failed delisting. By FY 21-22, it was all triumphant, boasting about record profits. Then we got this kind of diversionary focus on semiconductors, and now, in FY 23-24, the narrative is purely transformational, with this demerger being pushed as the ultimate fix-all solution.
At the end of the day, it all just boils down to this one enduring tension. On one side, you've got the operator, the investment thesis built on low-cost assets and the India growth story, and on the other side, you have the instrument, the antithesis, driven by promoter debt and that stubborn governance discount. The entire bull case, everything, rests on one single belief that this demerger can finally, once and for all, sever the link between the two. And that leaves us with the key, deciding factor for the next 12 months. Will this calculated demerger finally break the chains of financial complexity? Will it allow the world-class operator to finally triumph over its role as a high-stakes financial instrument? That is the multi-billion-dollar question that investors are placing their bets on right now.